Hi everyone, and welcome to today's Introduction to Steadyhand webinar. We're delighted you could join us. A couple of things before we begin. We'd love to hear from you, and please don't be shy to ask questions throughout the session. To ask questions, you'll find a chat button in the top right-hand corner of your screen. Simply type your question in the chat field and hit send. We'll try to answer as many as we can at the end of the presentation. And for those of you who have to leave the session, a recorded version of this webinar along with the presentation will be made available and posted on our website. I'm an investor specialist and partner at Steadyhand. I'm usually one of the first people you speak to when you call in. I primarily work with and alongside our clients to guide and give advice on their investments and portfolios. Joining me today is Salman Ahmed.
Hi, everyone.
Salman is a portfolio manager and works closely with Tom Bradley, the co-founder of Steadyhand, selecting and monitoring the firm's fund managers and investment philosophy. Usually when we host intro to Steadyhand sessions, they last about an hour. Salman and I have been ruthless in our editing of the presentation to deliver to you what we think are some of the key messages in roughly 30 minutes. But we would encourage you to spend some time on our website or call us if you want to dig deeper into anything we discussed or might have missed today. Over the next half hour, I'll spend some time introducing you to our firm. Salman will provide a brief overview of our funds and investment philosophy, and together we'll discuss what we believe is one of the most important things we do, which is how we work with our clients. We'll then open it up for questions. So this is Steadyhand. We are an independent, employee-owned investment firm. We opened our doors in 2007 and offer our services in 5 provinces. Our head office is located in Vancouver, and we also have an office in Toronto. We deal exclusively with individual investors and currently manage nearly $600 million for them. Our minimum is $10,000 per fund. One of the most asked questions we receive when clients are considering working with us is what makes Steadyhand different from its competitors? It's a great question, and we think a key one. But before I answer that, I want to step back for a second and talk about the why. The why of Steadyhand is pretty simple. We want to create change. We know it's a bold statement, but we want to change the landscape and level the playing field for Canadian investors. Individual investors in Canada have been woefully underserved by the financial industry for far too long. The distress of the financial industry in general is palpable, and for good reason. The fees being paid by Canadians to invest are amongst the highest in the world. The sheer number and complexity of financial products on offer is staggering, industry jargon confusing, the lack of transparency appalling. Sales pitches are often disguised as investment advice, and the advice that is being given too often is given in the best interest of those giving it and not receiving it. We felt there was an opportunity to make a huge difference to the individual investor and give them an alternative to the big banks and large fund companies who dominate the investment industry. We built our firm to challenge the status quo. We wanted to build a firm that managed the way we wanted our money managed, a firm that put our clients' interests first, and that's what's different. I'll speak to a few of these differences and the business principles we're uncompromising with, which we feel will lead to better outcomes and results for our clients in the future. We're an independent, employee-owned firm. My colleague David likes to say we are fiercely independent, and we are. We are an investment firm. That's all we do. There is no conflict of interest. And by that I mean we don't try to upsell you on a loan so you can invest money with us. We don't have a pension business on the side, and we're not interested in selling you insurance. We believe incentives drive behavior. As a result, we do not pay referral fees, we have no sales targets, and we do not work on commissions. We are also private employee-owned companies. We do not have public shareholders, and our business isn't driven on realizing short-term profits and growth for them at the expense of the long-term success for our clients. As a team, we're a stable, very experienced team of 13. One person is missing from the slide, and it's Evan, who recently joined us as an investor specialist to work with David in Toronto. The majority of us have spent our careers in finance, and we have a few veterans on our team, but I'll leave it to you to figure out who they are. We pick up the phone when you call in, and when you speak or meet with us, you're talking to either owners of the funds or partners in the firm. What is particularly unique to us is what we call and refer to as our co-investment. This 83% represents the average percentage of our family's own financial assets that are invested in the Steadyhand funds alongside our clients. We are invested in the same funds as our clients. We're on the same side of the table, so to speak. So I just spoke to what we believe are some of the foundations and building blocks of Steadyhand, but perhaps what is more impactful for our clients is how we communicate with them and our fee structure. We take how we communicate with our clients very seriously. We're cognizant of not pestering our clients, but we want to keep them well informed. Our website is the pulse of Steadyhand, but in addition, we produce a monthly newsletter, we blog 1 to 3 times a week, and we host client events. We try not to use jargon, and transparency in our communication is in our DNA. One of the most important documents we produce for our clients is our quarterly statements. Our clients receive the statements usually within a week of quarter end. We put up a sample statement as we think it's a good example of how we report to our clients. We want to convey 3 basic things on our statements: what our clients own, how they're doing, and how much they're paying us. I won't spend too much time on the first page of the statement, but we do list our clients what type of accounts they hold, the funds they hold, as well as we report their fees. It's shocking that until July of this year, advisors did not have to report what their clients were paying them for advice. We've done this since day one. We've reported the fees our clients pay us in percentage as well as dollar terms. The second stage is where we actually spend a lot of time with our clients. On the left-hand side, it shows their strategic asset mix, which we've nicknamed SAM. All that is a percentage of cash and bonds and stocks they hold in their portfolio. We report their actual performance, and that's their performance. And as an aside, any numbers that you see reported from us, either on your statement or on our website, are all after fees. But I did want to highlight one section on the statement. We frequently get asked by our clients, can you please tell me how much I started with, and have I made any money? We report this to our clients every quarter. In this example, our clients started with $16,000. Over time, they contributed and transferred in almost $410,000. And the $174,000 is the amount of money that they've actually made in their portfolio. And I'm going to end on fees. Topical at the moment, fees should not be the only consideration when choosing who to work with, but they matter. We think a lot. At Steadyhand, we're committed to keeping our fees low for our clients. Our fee structure works in 2 ways. We base the reduction on the size of your account. So as your money grows and the more you contribute, your fee is reduced. As well as the time you are with us, the firm, we call it a loyalty reward. So we reduce our clients' fees if they've been with us for 5 years and again at the 10-year mark, partly to keep our clients incentivized to stay the course and stick to their plan. And frankly, we get to know each other over time. It's less work for both parties. So as an example, clients who have over $500,000 invested with us and have been with us over 5 years, our fees are virtually untouchable. Fees are one of the biggest predictors of long-term investor success. The average fee Canadian investors are paying is 2%, in some cases higher. The average fee our clients, Steadyhand clients, pay us is 1%. That's a huge difference over time. That's a lot of money to keep in your wallet. So I've spoken about the why and the who of Steadyhand, but we are an investment firm, and the heart of what we do and have to deliver to our clients is performance. I'm handing it over to Salman to speak on this.
Thanks, Lori. With many low-cost solutions, there is a notion of getting what you pay for, but you're investing not just to save money, you also want your portfolio to grow. And with many other low-cost solutions, you don't always get top-tier products. Think about cheaper food, clothes, or even investment products for that matter. But with Steadyhand, you're not damned to mediocrity. It's quite the contrary, actually. We partner with some of the best managers around to help manage your money. These are specialists that only work with ultra-wealthy clients or large institutional investors that have tens of millions, if not billions of dollars. But by pooling our money together, an investor with a starting amount of just $10,000 can get access to these otherwise exclusive investment managers. What makes these managers specialized is their investment philosophy. It's what we call indexing, and something we really believe in. It's our way of saying that these funds pack a punch. They only invest in their best ideas, which means our equity funds hold between 20 to 40 stocks. There's no filler. They're not buying stocks or bonds just because someone else happens to own them or because they're in some benchmark. And they think about the long term. Now, this is really important because there's no shortage of experts out there that are telling us what to buy or what not to buy. But to be a good long-term investor, you don't just need to think about today or tomorrow. You need to think about 3, 5, 10 years from now. It's this investment philosophy that we think allows us to build better, more diversified portfolios. And I realize that sounds a little counterintuitive because I just said that our equity funds just hold between 20 to 40 stocks. But let's take a look at the S&P TSX. This is the most commonly used proxy for Canadian stocks. And you'll see here a big chunk of it, almost 34%, is in two highly volatile sectors, energy and materials. Energy stocks include oil companies and gas companies, while materials includes diggers for such things as gold, silver, uranium. We've always known that these two sectors are volatile, but the last 2-3 years in Canada has been a good reminder of this. Another 33% is in financials. This includes insurers and banks, and I know us Canadians love investing in banks, but owning 5 instead of 1 doesn't mean your portfolio is well diversified. The rest of the TSX is quite scattered, but it doesn't have a lot in consumer stocks or telecom, and it's got almost nothing in healthcare stocks or technology for that matter. Now let's contrast that with the Steadyhand Founders Fund. The Founders Fund is a balanced fund that's managed by Tom Bradley and me. Usually when someone says balanced fund, they're referring to a fund that holds between 50 to 60% in stocks and 40 to 50% in bonds and cash. We expect the Founders Fund to hold around 60% in stocks and 40% in bonds over the long term. As Lori mentioned, Tom's the co-founder of the firm, but he's also the president and chief investment officer, making him our boss. The fund itself invests in our 5 core funds: savings, income, equity, global equity, and small cap. Don't worry, there's no double dipping of fees here. Tom and I, we let the managers of the funds do the heavy lifting. They're the experts in buying and selling individual stocks and bonds. But our job is to assess the opportunities in the market and allocate to each of those funds and managers accordingly. And if we take a look at the equity sleeve of the Founders Fund, you see it looks remarkably different than that of the TSX. Yes, it holds some energy, materials, and financial stocks, but the portfolio is much broadly diversified. The largest sector is actually industrials, and I'd say it's a little unfair to even call this a single sector because it includes a wide array of companies, including contracting companies, consulting companies, and even some auto part manufacturers. There's a lot more in consumer companies as well, like Unilever, which makes the shampoo and detergent that you use. And there's a fair chunk in technology and healthcare. Now, it just so happens that right now we don't own a lot in telecom and real estate, but it's just because our managers don't see the opportunities in these two sectors that they have in the past. The Founders Fund also gives access to a variety of investments. Other than Canadian stocks, investors get U.S., international, and emerging market stocks as well. They also get a variety of bonds like government bonds, corporate bonds, high yields, and even cash. It's that mix of investment types and sectors and the undecking philosophy as a whole that creates funds that we think are better but also look very different than peers or benchmarks. And that's important because there are going to be times where our funds may do better than what's going on in the market, and there may be other times where the market's doing very well, but our funds aren't quite keeping up. Take our Steadyhand equity fund as an example. This is our Canadian-centric fund. While the Canadian market was down in 2015 by 8.3%, this fund was a mirror image. It was up 8.3%. Because we give CGOV, the managers of this fund, the freedom to go outside of Canada, fill those gaps that exist in the TSX, so they can buy a Mexican consumer company or a U.S. healthcare company, just to give you a little example. On the other hand, our global equity fund has struggled. It's been the most challenging fund for our investors to hold for that reason. I won't go into all the reasons we've stuck by Edinburgh Partners who manage our fund. We're happy to direct you to the analysis we've written on our blog and in our newsletter, or we're happy to talk to you about it over the phone or in person. But our analysis has left us confident that Edinburgh Partners will deliver, but we won't deny that it's taken us longer than we thought. Part of that analysis that we've done includes meeting with lots of other investment managers to get context. Just over the last year, Tom and I met with between 50 to 60 different investment companies and looked at more than 120 investment strategies to get a better idea of what's going on in the market, and it also helped us gain confidence in what Edinburgh Partners was doing for us. While we can do all the research and analysis on our funds and try to find those top managers for you, it's equally important for us to build that plan around the funds and managers. And that's how we work with our clients. Because as much as I'd like to tell you that it's an easy ride to your investing goals, the reality is very different. You're going to face lots of obstacles and hurdles along the way, some that you expect, but many that you didn't. The U.S. market is a great real-life example of this in action. This chart is of the S&P 500, which is a benchmark of U.S. stocks. It looks like a nice, smooth upward ride over the last 6 years. $1,000 in the start of 2010 would be about $2,400 today. But what looks great from a distance was actually punctuated with periods of sharp falls. In 2010 and 2011, the U.S. market fell by more than 15% in the space of just weeks before recovering. Even earlier this year, the U.S. market fell by more than 10%. And that's just when the market's fallen. There are other times when there's just broad uncertainty. Think about how you felt when Brexit was going on, or even now with the U.S. election on the horizon. Decision-making during these difficult periods is absolutely crucial. It can have a huge impact on your portfolio returns. There's a consulting firm in the U.S. called Dalbar, which put some numbers behind this, that compared how a U.S. balanced fund did and compared it to how an average investor did. A portfolio of 60% stocks and 40% bonds in the U.S. resulted in an annual return of 7.2% over the last 20 years. That's a really good number. In dollar terms, that means $100,000 would have grown to close to $400,000. But the average investor didn't even get close. Their average return was just 2.1%. That means $250,000 in our example would have been left on the table. Some of that gap has to do with the high fees investors pay and quite frankly, the crappy investment products out there. But a lot also has to do with not having a plan to deal with those difficult situations when there's uncertainty and market turmoil. And it also has to do with not having information on your portfolio when you need it the most. The experience of Steadyhand investors, on the other hand, is very different. We've tracked how our investors have done on average and compared it to our funds. On average, the numbers are virtually identical, and this is a huge source of pride for us because it's how we measure our success and yours. We can spend tons of time doing lots of great research and finding you those best-in-class managers, but there's not much of a point if our investors aren't reaping the benefits. We think this experience is a result of how we work with clients. We make collaborating the core of what we do. What you expect from us is that continued effort to find you those top-tier managers who pick stocks and bonds in your portfolio, and we're going to work with those managers to manage the overall risk in your portfolio.
And what we ask from you is to do some homework beforehand, to think about the purpose of your money, the time frame that you want to be invested in, and frankly, your goals. And then together, we collaborate. And so there's a lot of different ways that we work with our clients, but these are a few key ways in which we do. In an investment plan, we will sit and discuss your overall financial situation. We're going to dig into the details with you so we can come up with a plan to set in place. We'll talk about your risk tolerance. We're going to talk about your investment time horizon and also the purpose and the time frame that you had worked on beforehand. We've talked about keeping you informed throughout the presentation. We do that through newsletters and blogs. We'd like you to stay in touch with us that way, but we also need you to keep us up to date on any life changes, marriage, kids, approaching retirement, inheritance, travel, and the portfolio decisions. And as Solomon said, this is probably one of the key things that we can do. We encourage you to reach out to us at any time, and if that means you're calling us in the middle of Brexit, so be it. If you're calling us because there's been a really great positive event in your life and you want to make some changes, do it. But we're here for you. We want to answer questions about your statements, and that is what's so important to us. So I think we'll end here. We'd love to hear from you. So just as a closing, there's a lot of ways that you can reach out to us. You can give us a call. You can send us an email, check out our website, sign up for a newsletter. I think we'll leave it for questions, and we've had a few come in, which is great.
Yeah, here's one, Lori. Does Steadyhand offer corporate accounts?
Great question. So we offer virtually every type of account. We offer investment accounts, RSPs, TFSAs, and corporate accounts. Yes, we do. The only account type we do not offer is RESPs.
And here's another one that I'll attack. It's how often do you change managers? This is a great question, and it's quite timely. We are long-term investors, and for that reason, we think we give our managers a long window to perform, and we realize investing is a cycle, and there's going to be periods where managers are doing well and others where they're not doing well. So it'd be hypocritical for us to change managers very frequently. And in our almost 10-year history, we've only just changed manager once, and that was quite recently. It was about a month ago on our small cap fund. And that was driven by a couple of things. One was we felt that our indexing philosophy should really shine through in small caps. This is an area of the market where there's lots of opportunities. And we wanted to get some small cap, but also some mid cap stocks, which we didn't feel our investors were getting. And we also wanted to get some U.S. small and mid cap stocks. And the firm that we've partnered up with now, Galibier, a firm out of Toronto, they really have expertise in both. They do Canadian, but they also do U.S. stocks. So we've only done it once, and that was just a few weeks ago. And I think we'll wrap it up there. Those are the two questions we had. We're happy to answer any questions that you may have as you think about this. You can reach us on the phone, 1-888-888-3147, or give us an email at info@steadyhand.com, and we'll reach out to you. Thanks for taking the time today, and we hope you learned something about Steadyhand, and we hope to hear from you. Thank you.